The Metalbox pension scheme recently undertook a pension insurance buyout facilitated by PIC for £2.2 billion worth of liabilities. This transaction covered 10,000 pensioners and 2,200 deferreds. This is one of the largest buyouts undertaken by a UK pension scheme in the bulk annuity market over the last 10 years. The scheme itself was sponsored by Crown Packaging, who specialise in food and drink packages for numerous different products. And today we're going to talk you through a number of the interesting and innovative features that were underlining this transaction. With any large pension insurance transaction, there are a number of key areas that you need to concentrate on. Those are assets, reinsurance, legal terms, and operational capability. In terms of assets, we looked at the scheme's assets they were willing to pass over in specie, which were a combination of gilts, corporate bonds, and swaps. We also looked at how that compared to our pricing portfolio and compared the two. We then constructed an asset lock based on the scheme's assets, so the scheme was immunised against market movements from the point of exclusivity up to the point of transaction. We considered reinsurance both for pensioner lives and deferred lives, and had numerous counterparties interested across the market. And finally, we were focused on the operational aspects of this transaction. A scheme and a trustee board focused on ensuring the members were well looked after meant there were various areas for us to consider as we proceeded.
As you probably expect so far, we actually worked to sort of quite aggressive or challenging timescales. I think whilst the trustee and their advisors said probably engaged pickup on the insurance market approximately 12 months ago, it was only really in the last 3 months that they had selected PIC as their preferred insurer, and that's when the work really had to start. So over the course of 3 months, we had to set up a new administrator to administer the benefits after buyout, set up factors and the buy-in operation to make sure we're operationally ready, both for the buy-in and the buyout within 2 months. Undertake the due diligence again over the course of that time, as well as work on the policy documents, depot and supporting contract. Residual risk was actually a sort of very important part of this transaction. Certainly for the sponsor and for the trustee, one of their key focuses or outcomes was to ensure that after the buyout had occurred, should there be any data, benefit or potential legal issues in the future that might mean benefits were in any way wrong or people have been missed, that they chose an insurer that gave them the most cover possible to ensure that should any of those occur, that the insurer would stand behind that. So in order to effectively undertake that assessment, it did take quite a bit of work. Certainly we had a sort of bias report approach which brought forward a number of the potential legal issues that might be involved in the transaction. That gave us a bit of a head start. And then what we really had to do was bring together sort of data expertise, operational and pricing expertise to then undertake an intensive due diligence process over the course of 6 to 8 weeks.
In the near term, we think this transaction forms a blueprint for how large pension schemes in the UK can fully immunise themselves from investment risk and demographic risk and legal risk that may sit on their balance sheet through their legacy defined benefit pension schemes. As schemes continue to mature across the UK, we think full buyouts will continue to become more and more prevalent in the UK. One interesting aspect of this transaction, which we think is going to be more and more prevalent also, is the existence of illiquid assets. In the case of this transaction, a loan was made from the company to the trustees to enable the buyout to proceed whilst the illiquid assets were sold over an extended period running into next year prior to wind up. The first is in terms of a collaborative approach to working through the project. These projects involve hundreds of people across advisors from the corporate side, from the trustee side, from the insurer, from lawyers on both sides and also from the insurers as well. And having all of those people work collaboratively to one common goal is a challenging feat and involves significant project management and also the willingness to want to achieve the target at the end of that process. Secondly, we advise plenty of time. So this was an ambitious project that incorporated a number of different aspects in challenging timescales, but those timescales were well trailed, approximately 12 months prior to the actual execution of the deal. And then lastly, we think a dynamic governance process is also important. So as and when things come up in a process like this, which they inevitably do, the ability to react to those, to respond to those, to discuss those, is critical to ensure the transaction stays on track.